Let's talk about the loan, right? The loan is very important, and also talk about not just the interest rate and the loan to value, but how the loan is so much different than it was even 2.5 years ago.
The loan that we got on this deal was really low risk. And the reason for that is because of the leverage. So in this environment, it's harder to do deals because you have to come with more equity to deals because the lenders are not giving you as much money. Now, the downside is that it's harder to get deals done. You have to do smaller deals because your equity doesn't go as far. The upside is that your mortgage payment's so much less, so your risk is lower essentially. So this one was 65% LTV. That means they gave us 65% of the purchase price of the property as a loan. The rest was capital that we raised. We had no construction dollars given to us by the bank. It was just all our own. So we had to raise additional funds for that. And there's a lot of just equity in the deal. And so if anything were to happen, things go sideways, you're fairly protected in that scenario. Also, it's a fixed rate loan, so it's not subject to the market conditions. You know exactly what you're paying. You know how that's going to look, and then you just pay it. And what we've seen in the past is we had these really attractive loans out there when interest rates were basically at the bottom, and they're variable rate loans, but they gave you construction dollars and they gave you a lot of money. So you could get up to 80% leverage, plus you could get your construction dollars on top of that, which was attractive because you're just trying to do a short-term play. Project rents are flying up, everything's flying up. So you want to get into a more fixed rate debt situation in a couple of years once your project was done. And then the lender would take care of the entire project for you. So those were very attractive at the time. Looking back, they were not so attractive because they're subject to the variable rate situation, right? So if as interest rates go up, so do yours. So our debt service payments, or had to pay whatever we had to pay the lender, doubled, sometimes tripled. And so that obviously made it very difficult. And for a lot of people out there, everybody out there, extremely difficult to navigate that. So that's kind of why you're seeing pricing falling right now, is because of the whole debt structure. And the debt structure is very important in the success of your deal, and in general, that you have to look at the full capital stack, how it's being put together, and the spectrum of risk. Obviously, with the loans that were being done before, those are a little bit higher risk because of the variable rate component. If you're getting into fixed rate debt, that's just generally lower risk.
And we're talking about now the risk adjusted return. This is very important for both passive investors and also the operators to understand risk adjusted return, which means that if I have a 15% average annual return, okay, not all deals are created equal. It really depends on what the risk is, the underlying risk is, why you have to ask questions like this. For example, if the loan product now, what Garrett is saying, is 65% loan to value, and I don't get a construction, my overall leverage is much, much lower than it was, say, 2.5 years ago. When I'm getting 80% loan to value and I'm getting the construction dollar, so the overall leverage is much higher. Also, from a market perspective, interest rates were basically close to zero, and the general consensus was that interest rates are going up. No one could foretell it went up so quickly, but the consensus was it's basically we're at a historical low. So you can look at the risk adjusted return within the asset class. It was towards the riskier side of it for that reason. If you look at the same thing now, you could argue that you're on the completely other side of the risk adjusted return. If, for example, what would happen to prices, Garrett, if loan to value would go up to 75% again?
So if everything is yield based in commercial real estate, right? So you're seeing right now in the markets, residential real estate's not really impacted by everything that's gone on when interest rates went up that much. That's because of supply and demand. People that have homes and they got in them for 3% interest rates, they're not selling, they're just holding on to them. There's not enough supply. So nothing's really changed. But in commercial, it's all yield based. So everything is based on what kind of returns you can produce, right? And so if you have to pay the bank more, you're going to be able to pay investors less, like I mentioned before. Now, if you have a higher leverage, it's going to allow for your returns to look better in general, and pricing will push up. Just because you can get more money from the bank, it's cheaper than bringing equity. And there's that risk adjusted scale, though. As you go up in leverage, it's a little more risky. So you have to pick the right point as to where you want that to be. But generally, if you can get back up to 75, even 80% leverage, pricing is going to go up.
Yeah, so you have to understand the risk-adjusted return. So you just don't look at the return to make a decision. And the other thing to look at is the underlying underwriting assumptions. So let's talk about that. Let's talk about some of the assumptions that maybe we had. Let's pick, the rent assumptions, right? Rent growth assumptions, vacancy assumptions. Let's start with those.
Sure.
And to see the questions to ask around these stuff, if I'm projecting 10% rent growth, is that in line with projections? Or is it 2%? Why did we project what we did?
Yeah, so some of the projections that we had, we always like to do a high economic vacancy in the beginning because you never know what kind of challenges you're going to run into once you get into a deal. It's the staff could not work out. Maybe you're not getting the rents you wanted right away, so you want to underwrite higher economic vacancy in years 1 and 2 always. And so that's what we did. Our economic vacancy was somewhere around 5%. And that's going into the deal. We underwrote it at 15% just to give us that extra room. We've had a deal before that we did, the one that we did last year. We underwrote a 40% economic vacancy for years 1 and 2. And if you can exceed that, then you do better, obviously. But if you can't, then at least you have that cushion. So I think that cushion is super important. That's what we did on this deal specifically. So we started there. I think that's always a really good measure to ensure that you succeed. So even if things aren't going right, you're not stressed. You can still produce returns. You can still distribute to investors because you have that accounted for. Everything in your underwriting is based on where you think things are going to go, but then take it back a step and make it more conservative so that if things don't exactly go right, you can still overcome that situation. Other assumptions on this deal. So we had insurance increasing by a decent amount, about 20%, which is kind of the standard that we've seen on renewals. And so that was obviously you get quotes for that type of thing, but insurance has just been one of those things that's been a wild man. It's just going up like crazy. It's not increasing at 3%. It's like 10% a year. So you have to account for that kind of thing when you get in the deal. Taxes, same thing. We always account for taxes going up to the highest level. And then if we're able to beat them down somehow through the legal system, which we usually are, then it's a bonus. But we're going to the highest level of tax hikes that we think are going to happen, and then it's a bonus. So that was an assumption that we made right out the gate. Sometimes you'll see people with payroll that is way lower than what you really can afford in the market, and you have to just do the math. Like, how much does it cost for a good manager? How much does it cost for a good maintenance person? Okay, those two people, their salaries plus their burden costs, that's going to be what you're going to pay, and that's it. It doesn't matter if someone else put down that they get $1,200 a month for payroll per unit, or $1,200 a year per unit. If you can't do that, if you can't get to that level, you have to be realistic about what number you're putting in there. It used to be that you could get $1,200 a unit on payroll, and now it's at $1,800. And that's just what it is. And so those are things that you'll see their expenses, the seller's expenses, and you'll see what the broker even projects out. And this is what we think. And it's all kind of BS. It's not about what they're doing. It's about what you can do. And so you take it with a grain of salt. I never really look at the broker's pro forma that much. I don't really I always take that with a grain of salt because they're always pushing things to get the best numbers. And you got to put your own realistic assumptions in based on what you really feel like you can do. That way you're not stressed when you actually get into the business plan.
Now, a big one, Garrett, is the exit cap. Now, just a quick explanation around on cap rate. Cap rate is basically a multiplier you use to determine the value of commercial real estate. So in general, the higher the net operating income, the higher the value of the building. And so because of this, it has an inverse relationship to value. So in other words, the lower the cap rate, the higher the value, et cetera. So for example, a couple of years ago, it kills me. Operators are putting out deals, and everybody knew that the interest rates were going up and their exit cap rates were lower. They're telling them that they were going to go back lower. Now, a half a point increase in cap rate makes a huge difference in returns. I mean, I'm talking huge. It can make it go from 15 to like 19% average annual return, just a half point move in a cap rate. So the cap rate is a big deal. And so in this particular environment where we're projecting stable to slightly declining environments, you could make the argument that cap rates could actually be lower. And so, but still, you got to look at the exit cap rate and see what is it, right? What is it now? What's being projected? and then ask questions. Why do you think it should be lower, right? If the higher it is, the more conservative it is. So the exit cap rate is another thing to look for. Now, what about the reserves? Now, this is another thing that kills me, right? You look at a P&L from an operator, and there's no reserves going in, there's no reserves being withheld from cash flow, and of course, the returns are high because of that. So talk about returns to look for, and then maybe what we use in our deal.
Yeah, so reserves, you're always going to underwrite at least 250 to 300 per unit in general. That's just the lender's reserves. They're going to make you do that no matter what. But you want to have additional reserves outside of that because things are not always going to go as planned. You're going to, it doesn't matter how many times you update your construction budget, there's always going to be unknowns that come up. And so you need to make sure that you have enough cash so you're not strapped and you're able to execute the business plan properly. In our deal, I think we used on this one about 15% of our total construction budget. We put in reserves. You can do it as high as 30% or 50%, whatever you want. But at a certain point, it does impact your overall returns. But it was a couple $100,000 that we had outside of everything that we could think of for our construction. And we felt like that was a good number for the size of this deal. So you'll go in, you'll tweak some of your construction numbers, will come in lower, some higher, and then you'll have those complete outliers that you didn't even know existed. Always happens. It's unavoidable. So the reserves are extremely important, and that way you can cushion yourself against any potential headwinds that come.
So you're looking for, multiple margins for error. You're talking about in rent growth and vacancy and exit cap, interest rates, that kind of stuff is kind of what you're looking for. So in general, okay, we went through a lot of the questions to ask as a passive investor before investing in a real estate syndication. And if you're an operator, proactively address these questions to your investors as you're doing your presentation, you're putting out your marketing materials. And so really, it's a lot about the story. Ask questions, and does the story make sense? Does the story make sense of what the problem is with the property, why the rents are lower? Does the business plan make sense to you? Then what are the projections, but more importantly, what are the risks? And what are some of the underwriting assumptions? And are they conservative? Do they make sense to you as well? So those are some of the questions to ask, in addition to doing some due diligence on the operator. So we would love to be your trusted source for multifamily deals. So check us out. We're at nighthawkequity.com. You can download some information. You can register and have a call with us. We'd love to have a conversation about some upcoming deals. So hope you all found that helpful if you're a passive investor, but also if you're an operator as well. So Garrett, love jamming with you, man.
Yeah, man, it's fun.
All right, with that, maybe we'll take some questions from the chat here. Let's see what we got. Let us know via chat if you have any questions.
Bueller.
That's all right. Thought a kind of fun thing to do every once in a while to. Yeah, I think the recording will be shared. Madeline, what is are we going to have a recording? Anything you can say about that?
Yes, by tomorrow afternoon, I'll have it sent out.
All right.
So
you see the question from Sean? Yeah.
Yeah, Sean said, can you detail in the increase in interest reserve that I was saying, said 15%. So it's so you have two things going on. You've got 250 to 300 per unit, okay, per year. That's going to be
we forgot that you forgot to mention that, right? Because the 15% was going in. It's 50% of the construction budget. Yeah, you forgot to mention what you're about to mention now.
So there's two reserves that are happening. The lender's going to require you to bring somewhere between $250 to $300 per unit per year. That's going to go just to them as a reserve that they build up. Okay, so that's always a part of the loan typically. Outside of that, take your total construction dollars, times that by 15%, and that's a good reserve to have. It can be as low as 5%. I wouldn't recommend that, all the way to as high as 50%. But at some point, you're going to have to pick what point you think is the right level and add that into the model.
All right. So Tim is asking, define our IRR again. We didn't really define it, but this is a great use of ChatGPT to ask questions like that. I'll wave my hands on IRR. IRR is a very complicated metric, but the cool thing about it is that it can be used to measure the returns of any kind of investment. And the reason it's a little more complicated is because it accommodates both inflows and outflows of an investment, as well as the passing of time, right? And the average annual return, for example, does not. So for example, if one were to refinance something and return half of your principal, the average annual return calculation would simply break down. The IRR takes it and calculates it. So you can literally compare investing in stock equities versus gold versus multifamily versus crypto, whatever you want. And it's the great unifier. It's actually a formula built into Excel. And so that really is a true measure of any kind of investment. So I'm going to wave my hands. I can probably read it from chat, but essentially that's what it does. Anything you want to add to that, Garrett?
Yeah, it's just different. It's based on time. So that's it. I would if you want to learn more about it, I'm sure you just there's a whole formula calculation. It's fairly simple, and there's a way to calculate it very easily. But that's generally, for whatever reason, that's what was selected as the main way to value and project out what these investments can do.
Yep. Cool. Good questions. What else you got? Now we'll let you get on with your day. And that's just what we'll do then. Yeah, that's good. Awesome. Yeah. Thanks so much for hanging out here with us. Oh, there we go. Bruce has got a question.
Okay, this is good. So what I'll say, this is the question is read online that a trend that sellers are trying to sell at a 5 cap and buyers want it at a 9 cap. That sounds like this is a trend. So I'd say that generally what you're talking about here is a gap between what sellers want and what buyers want to pay. And a deal only happens if someone can be realistic about what the market's trading at. So right now, in general, the market's trading anywhere between a 5.5 to 6.5 cap, depending on the asset class, depending on the location. That's just what the market is. So you can't really beat the market. Someone that wants to sell at a 5 cap, and someone will only buy at a 9 cap. They're both wrong. Okay, it's because where it needs to meet is at that 6% level. That's just where the market is trading. Everything else in the market is trading right around that. So, and there's a little bit of fluctuation in that, but what you're seeing out there right now is the people that are realistic. You were seeing deals trade at 3.5 caps before, and now it's gone all the way up to a 6.5 cap. And that difference is a big drop in price in general. So it's an inverse relationship. Your pricing goes down as cap rates go up. And so as long as you can get to a place where people are inside of that market cap rate range, then a deal can happen. And if not, it won't.
Yeah. The question from Sean, it looks like he's an operator. Got a question about getting CapEx reserves back. Those pesky lenders, there definitely can be a challenge to work with.
Yeah. So said that the lender's not responding to requests to get the funds back. Yeah. So I think lenders in general are being more conservative, and even to a place where it can be unsettling. And so if they're not responding, that is an issue. They need to be communicating with you. Of course, it's difficult right now in general to get a loan. So if you're trying to go get a new loan, a lot of lenders are retrading you at a certain point. In fact, on this deal, we had a lender retrade us. We had to get away from the lender and start with a new one. And so when markets tighten, you see lenders behave differently. And that's one of the challenges of getting things done in this market, is whether it's construction money back or it's a new acquisition or refinance or whatever. Lenders can take their sweet time, and every lender is different as to how they're operating behind the scenes. And so, yeah, I'm sorry you're dealing with that, but that's just the reality of the situation right now.
All right. Thanks, everyone. Thanks, Garrett. Appreciate it. See you guys next time.
See you guys.
Bye.